Here's something that should make you genuinely angry. There are thousands of books dedicated to analyzing Warren Buffett's portfolio. There are entire YouTube channels, some of them massive, dedicated entirely to tracking what he buys, what he sells, when he moves, what percentage of his holdings is in Apple versus Chevron versus Bank of America. Every quarter when Berkshire Hathaway files its 13F disclosure, the financial internet goes absolutely wild trying to reverse engineer his thinking. And in focusing entirely on the stocks, the sectors, the valuations, almost everyone completely misses the only thing that actually matters. The thing Buffett himself has said clearly, plainly,
Listen up!
repeatedly,
These letters demand
in dozens
action
of
now!
interviews
I won't
and
stop until
shareholder
justice is
letters
served!
over
Hear
5
me
decades.
roar!
The single behavioral rule that is more directly responsible for his wealth than any individual stock he has ever purchased. It's not a secret. He's said it out loud. Loudly. Many times. And still, the overwhelming majority of retail investors hear it, nod along, and then go right back to doing the thing that guarantees they will never get his results. My name is Astrid. I obsess over investor behavior, not investment theory, not portfolio strategy, not stock picking frameworks. Behavior. Because after years of studying how wealth is actually built and destroyed, I can tell you with complete confidence that behavior is where the game is won or lost. Not stock selection. Behavior. And understanding this one rule will change how you think about every investment decision you make from this point forward. If you ask most people what makes Warren Buffett great, you'll hear the same answers. Value investing. Buy wonderful companies at fair prices. Hold them forever. Let compound interest do the work. Don't try to time the market. Be greedy when others are fearful and fearful when others are greedy. None of that is wrong. But all of it is describing the strategy, the surface layer of what he does. None of it explains how he actually executes that strategy across decades of extreme market volatility, economic crises, media panic, and social pressure. None of it explains the mechanism that allows him to actually do what he says while millions of investors who have read the exact same advice repeatedly fail to replicate it. The strategy isn't the secret. The structure underneath the strategy is the secret. And almost nobody is talking about it because it doesn't make for exciting content. It doesn't give you a hot stock tip. It doesn't tell you what to buy this quarter. It just quietly explains why most people who try to invest like Buffett end up getting results that look absolutely nothing like his, and what you'd actually have to change to close that gap. Let me hit you with some data that should be uncomfortable if you've ever made a financial decision based on emotion, which, if you're honest with yourself, you probably have. A landmark long-term study by investment research firm Dalbar has tracked the actual returns earned by average equity mutual fund investors versus the returns of the S&P 500 index over the same periods. The results are devastating. Over a 30-year period, the S&P 500 returned roughly 10% annually. The average equity investor? Around 7%. Sometimes less. That gap, 3 percentage points annually over 30 years, represents a difference of hundreds of thousands of dollars on a modest investment amount. On a large investment amount, it's life-changing money. The investors weren't in bad funds. Many of them were in perfectly good index funds that returned exactly what the market returned. The gap came entirely from their behavior, from buying after the market went up and selling after it went down. From panicking during corrections and piling in during euphoria. From doing the exact opposite of what any rational long-term investor should do, but doing it in a very predictable, very human way. Now let's talk about the specific moments that define long-term investing outcomes. The 2008 financial crisis. The S&P 500 dropped approximately 57% from peak to trough. It was genuinely terrifying. The news was apocalyptic. Banks were failing. Unemployment was spiking. Major financial institutions that had existed for over a century were disappearing overnight. Hundreds of billions of dollars fled equity markets from ordinary investors who looked at their retirement accounts and decided they couldn't take it anymore. Warren Buffett bought. He bought aggressively. He wrote an op-ed in the New York Times in October 2008, right near the bottom, saying he was buying American equities and that if prices stayed attractive, his personal portfolio outside of Berkshire would be 100% U.S. stocks. The market recovered. The people who sold locked in permanent losses. Buffett's positions multiplied. Then 2020. March 2020. The COVID crash. The S&P 500 fell 34% in 33 days, one of the fastest market declines in history. Individual investors pulled hundreds of billions of dollars out of equities in a matter of weeks. Margin calls were triggering forced selling across the market. The news coverage was relentlessly catastrophic. By August of that same year, the market had fully recovered and was setting new all-time highs. The people who sold in March missed one of the fastest recoveries ever recorded. So, what is the actual mechanism that allows Buffett to hold and even buy in those moments when every human instinct and every news headline is screaming sell? What does he know that most investors don't? And is it something you can actually replicate, or is he just built differently? Here's the answer, and it's going to sound almost disappointingly simple. But stay with me, because the implications are enormous. The rule isn't about what to buy. It isn't about valuation metrics or sector analysis or understanding a business's competitive moat, though all of that matters. The rule is this: Buffett has spent his entire career systematically engineering his financial life so that market volatility is psychologically harmless to him. And that structural preparation is what allows the strategy to actually work. Think about what forces most retail investors to make bad decisions during market crashes. It's almost never stupidity. It's almost never a lack of knowledge about investing principles. It's structural vulnerability. They have margin debt that forces them to sell when prices fall below a certain level. They don't have a cash cushion, so a market downturn coincides with a life expense, and they need to liquidate at the worst moment. They're emotionally checking their portfolio every day, sometimes multiple times a day, and the psychological weight of watching the numbers fall becomes unbearable. Buffett addresses every single one of those structural vulnerabilities deliberately. He famously keeps a significant amount of cash at Berkshire, tens of billions of dollars, that critics constantly say is a drag on returns. He calls it his elephant gun, the money he can deploy when something extraordinary becomes available at a price he couldn't get in normal markets. That cash doesn't just provide financial optionality. It provides psychological optionality. When the market falls 40%, his first emotion isn't fear. It's curiosity about what he can now afford to buy that he couldn't buy last month. He has no debt that can force a sale. He has no margin calls. He has no investors who can pull capital at the worst moment. Berkshire's structure as a holding company with publicly traded shares means shareholders can only sell to other shareholders. They can't demand their money back during a crisis like hedge fund investors can. He doesn't check stock prices obsessively. He has said multiple times that if the market closed for 5 years it wouldn't bother him because he's buying businesses, not trading pieces of paper. That's not just a clever quote. It's a description of a psychological relationship with investing that is only possible when your financial foundation is solid enough that short-term price movements are genuinely irrelevant to your life. He copied none of the flashy parts of his strategy. He meticulously, deliberately built the boring foundation that makes the flashy parts possible. And almost nobody who tries to replicate him copies that part. They read about value investing and skip straight to picking stocks, without building the structural cushion that lets you actually hold through a 50% drawdown without losing your mind. So, what does this actually mean for you? How do you take a principle that sounds simple and turn it into something that changes your financial outcomes? It means you have to build your investment structure before you make your first investment decision. And that structure has a very specific sequence. First, your emergency fund has to be large enough that a market crash doesn't coincide with a personal financial crisis. If you have 3 to 6 months of living expenses in cash, a job loss or an unexpected expense doesn't force you to sell investments at the worst possible time. This is not exciting. It is the single most important investment decision you will ever make. Second, you cannot have high-interest debt and be a rational long-term investor at the same time. Debt at 22% is a margin call that never stops. It creates ongoing financial pressure that makes every market decline feel like an emergency. Pay it off before you invest a significant dollar in equities. Third, build your tax-advantaged accounts, your 401k match, your IRA, your HSA, before you start picking individual stocks or trying to be clever with your taxable account. The guaranteed return of your employer match and the tax efficiency of these accounts are structural advantages that no stock picker can reliably beat. Fourth, and this is the one most people skip, once you start investing in equities, commit in writing to your own rules about what would cause you to sell. Not, if the market drops and I get scared. Real, specific criteria. I will only sell if the fundamental business has deteriorated, not if the stock price has fallen. Then hold yourself to it. The investors who replicate Buffett's structure, even if they use simple index funds instead of individual stocks, get results that look dramatically better than the investors who copy his stock picks without copying his foundation. The structure is the strategy. The boring preparation is the secret weapon. The emergency fund, the debt payoff, the psychological architecture that makes volatility feel like opportunity instead of catastrophe, that is the real lesson. You don't need to be Warren Buffett to invest like him. You just need to be boring enough, patient enough, and structurally prepared enough that when the inevitable crash comes, and it will come, it always comes, your first thought is, what can I afford to buy right now, instead of, how much have I lost? Most people will hear this and keep looking for the next hot stock tip. Which means most people will keep getting average results at best and panic-driven disaster at worst. The decision is completely yours. But if you want to do something genuinely useful today, don't open a brokerage account. Build the foundation first. Everything else comes after.